Hello and welcome to my YouTube channel called Harshmeet Study Circle. This is chapter number 2 of the summary of this year's economic survey. Yesterday, I put out a video summarizing chapter number 1 of this year's economic survey. As I told you in the last chapter also, there are 13 chapters in total and we'll be summarizing them all because these are extremely crucial for your examination. We have taken out the most important information out of it, and in the end I'll also have some questions for your practice so that you can test yourself. So the second chapter of this year's economic survey has been titled Monetary and Financial Sector Development. So mainly this chapter is divided into two parts. In first part, the economic survey talks about the monetary policy adopted by the RBI this year, the impact of those policies on the banks, on the liquidity in the market, how has it impacted the common people. And in the second part of this chapter, they are talking about the financial sector in India, investments, etc., the profile of the investors, how is it changing, how is it evolving, all these things are mentioned. So these are the two major components of this second chapter. So as I said, let's start with the first one, that is the monetary development. As I said earlier, monetary developments mainly includes the actions of the RBI, monetary policy stand, money supply, etc., and the liquidity situation in the country. So first highlights. Now, as you know, we have something called the MPC, Monetary Policy Committee by the RBI, whose main job is to keep a check on the inflation in the country. Now, the inflation targeting is 4% plus minus 2%, means 2 to 6% is the range that we hope inflation would be in. The RBI's Monetary Policy Committee makes sure that the inflation does not go above 6%, does not go below 2%, because zero inflation also is bad for the economy. How do they do that? They keep on changing repo rate, they keep on changing other measures so that the liquidity, the money supply in the market is controlled. Now, as per the economic survey, for the first 3 quarters, that is for the first 9 months, repo rate by the RBI was kept unchanged at 6.5%. Also, we saw the RBI finally changing its policy from withdrawal of accommodation to neutral. Now, these are important phrases which can be asked in the examination, so you must know this. When you say RBI is following withdrawal of accommodation, what does it mean? What it means is RBI is trying to suck out liquidity from the market. Now, when the RBI suggests, or when the RBI thinks that there is too much inflation, that is, the prices of commodities are increasing, one of the main factors can be that people have too much money in their hand, or money is easily available, so they are buying a lot more stuff, because of which inflation is increasing. So as a result, what they try to do is to control the inflation. They try to bring money out of the market. How? They make it difficult for you to get money. They will make it harder for you to get loan. The loans will cost more. That is called withdrawal of accommodation. So to control inflation, it's a very common thing. In October 2024, finally RBI changed its stand and became neutral. Neutral means not deliberately trying to withdraw money from the market and not pushing money into the market, maintaining a neutral stand altogether. This is called having a neutral approach. So RBI changed its approach from withdrawal of accommodation to neutral in October 2024. Cash reserve ratio was also reduced. Now, as you know, cash reserve ratio means the amount of money that the banks have, which they are supposed to keep in cash, so that it can be used if there is an urgent withdrawal. When the RBI reduces this requirement, for example, RBI said that from 4.5% now you only have to keep 4% cash with you, means banks now have more money to give out the loans. That means it will increase liquidity in the market. When they increase the cash reserve ratio, when they tell the banks you have to keep more money with you in cash, that means you are withdrawing money or withdrawing liquidity from the market. So cash reserve ratio was reduced, was cut down from 4.5% to 4%, which increased liquidity in the market by about 1.16 lakh crore. That also was an indication that RBI wanted to give more money in the hand of the people. They're not worried about inflation now. About money supply, what changed? So there are important terms that you would know in economics. First, reserve money, which is called M0, it grew by 3.6%. Broad money, which is M3, it also grew by 9.3%. And then money multiplier, MM, which is a good indication of money supply in the market, it also increased to 5.7. So higher money multiplier, higher MM, means that you have more money into the market coming in. means you have more money in the hands of the people, more liquidity, people are buying more stuff. Apart from that, the banks were encouraged to give more loans. Banks gave more loan to commercial sector, which also increased the money supply in the market. The money multiplier, that is the liquidity, has reached a good level. It had declined during the COVID-19 pandemic, but now it has again reached a good level. So there is more money in the market, which is also done to increase the consumption. When people, the local market consumes more, when they buy more stuff, it gives a push to the industry as well, which are producing that stuff. Those were the monetary policy developments as per the second chapter. Now, economic survey in the second chapter also talks about the financial sector developments of this financial year. Now, what are those developments? First, about the banking sector. For a long time now, banking sector has been facing a lot of flake because of increasing NPAs, non-performing asset. The good part here is gross NPAs have declined. They have in fact reached a 12-year low. They have only now at 2.6% in September 2021, which is a good sign. So net NPA, not performing asset, the money which is not coming back for the banks, declined to 0.6%. Also, the capital to risk weighted asset ratio, that is CRAR, of the scheduled commercial banks also remained at a good level. Means that they have good stability, they do not have a lot of capital in danger, which is always a good sign. Here is a graph from the economic survey which shows you how the gross NPAs have been declining. So in September 2024, they reached at the best point in the last 12 years. Also, CRAR is also well above the required norms as per the Basel norms. So the banking sector seems to be doing pretty well. Bank credit is also increasing, means banks are giving out more loans, so they trust the people more, they trust that the money will come back. So that is also a good sign going forward. About the capital market also, that is the stock market, there's a good sign coming in as per the economic survey. In December 2024, India's stock market outperformed all the emerging countries in the world. Number of IPOs also increased considerably, means a lot more companies became public, opting out to have public money being invested in them, which is a good sign. When a company goes through IPO, means they are opening up their financials for everyone to see, so it brings a lot more transparency. It also brings a lot more investment opportunities for the common people. It also led to financialization of domestic savings, means the domestic savings were not just kept in the bank account, they were invested also, which led to better wealth creation. Insurance pension sector also did well as per the economic survey. India is projected to be the fastest growing insurance market in the G20. Now, there are two factors related to this. One, because of our high population, we always would be a big insurance market. And secondly, because the penetration of insurance is still extremely low. Still, a large population or a large proportion of India's population does not have insurance coverage. So the potential for insurance and this sector to have big numbers is humongous, and that is why we have seen this growth. Financial inclusion also was a big theme in this year's economic survey. They talked about how financial inclusion index has improved, means more and more people are coming into the financial sector. They are now operating their own bank accounts. They are now a part of India's growing economy in the formal sector. Rural financial institutions also played a good role in making sure that the loans are given out to people who are living in far off areas, not just in the urban areas. We also had the Unified Lending Initiative by the RBI, which enhanced the digital lending for MSMEs. So MSMEs, the small, medium enterprises, also were given loans at a much better condition through the banks. Consumer credit also grew, means credit, that is the loans given out to consumers rather than just corporates, that also grew. So banks were giving out more loans to individuals as compared to the businesses, which is also a good sign because it will increase consumption. Rise of non-bank financing, means apart from the banks also NBFCs, non-banking financial companies, they also gave out many more loans to people for whom banks are not accessible. There is also an increase in unsecured lending, which is slightly worrying. Unsecured lending basically means lending by those companies or those organizations which are outside the purview of regulation of the RBI. So that is a slight concern, because when you're outside the purview of RBI, you are not bound by that. The rates of interest are much higher and these are unsecured loans. So it is a major cause of concern. Then the economic survey in this chapter talks about some emerging trends and risk in our financial sector. For example, first emerging trend is the rise of young investors. If you look at the number of investors under the age of 30 years, they are about 40% of the entire stock market investors, which is a very, very, very good sign. Means people are achieving financial independence at a much younger age. They are investing at a much younger age and they are not afraid of making these financial decisions for themselves. Equity-based financing also increased. India ranked first globally in the IPO listings. So no country had more IPO listings in the entire world than India in financial year 2024, which again is a big sign. And I told you earlier, large number of companies coming to IPOs means more investment opportunities. Companies are open to scrutiny. They are under regulations of SEBI, so which is always a good sign. Also, there are certain risks involved. For example, when financial markets control many companies, it will lead to systematic risk. For example, when Sensex goes down or when there is a negative news in the global market, it might impact all the companies that are listed. So companies that are listed always would have to face certain danger of shocks from the stock market. Balancing financial growth and stability is also important. So both of these have to be given or have to go hand in hand as per the economic survey. Economic survey in the end of this chapter talks about the financial sector outlook, means what is a prediction in the coming few months. It says financial sector will have a strong growth and will continue the digital transformation. It also says that financial services also would see a lot more innovation coming in, and capital markets, stock exchange, etc. will drive the expansion. There will be many more people who will be investing in these markets in the form of IPOs, etc. This was the main summary, the main pointers from the second chapter of this year's economic survey. Now to test yourself, I have a few questions. Let's see if you can get them right. First, and see this carefully, consider the following regarding money multiplier. First, an increase in money multiplier indicates improved financial deepening and liquidity in the economy. Is it? Yes, we just discussed that. Higher the value of money multiplier, higher is the liquidity in the market. Money multiplier decrease in financial year 25. No, we just discussed it's the opposite. Money multiplier increase, so there was more liquidity in the Indian financial system. MM is calculated as a ratio of M0 to M3. No, it's the opposite. It's M3 is to M0. So money multiplier is broad money upon reserve money. So the answer here is A. One only is correct. The second and third statements here are wrong. By the way, I will upload this PDF and PDF of the first chapter as well on my Telegram channel. If you have still not become part of it, I'm giving the link in the description of the video. You can join that as well. Second question, what is the main purpose of RBI's neutral stance in monetary policy? We discussed this. Exclusively target inflation without focusing on growth. To maintain a balance between inflation control and economic growth. To increase money supply or to reduce fiscal deficit. We discussed how RBI has changed its stand from withdrawal of accommodation to neutral. Neutral means now they are trying to balance inflation and economic growth. Rather than focusing on one, they are focusing on both now and trying to balance it out. So the answer here is B. Next, which of the following factors contributed to reduction of gross NPAs of scheduled commercial banks? As we discussed, NPAs have come down to the lowest point of 12 years. What are the factors? Improved credit risk assessment, yes. Higher loan recoveries, yes. Lower fresh slippage, yes. All of the above are the factors because of which we have seen that the NPAs, non-performing assets, are declining, which is a good sign in going forward for the banks. One more question. What does the Financial Inclusion Index measure, FII? Level of financial literacy, not just this. Percentage of population of bank account, not just this. Accessibility, availability, usage of formal financial services. This is what FII measures. As we discussed, FII is improving. It means availability, access, usage of financial services is increasing. It's improving in India. One last question. Which of the following is not considered a component of broad money, that is M3? Currency in circulation, demand deposit, time deposit with the banks, or net forex reserve? The answer here is net forex reserve. Tell me in the comment section, what is M0, what is M1, what is M2, what is M3? Tell me the formula for all these, M4 also. Tell me the formula for all these in the comment section. I want to see if you actually know this or not. This brings to the end of this session. I'm reminding you once again, my prelims crash course for 2025 is running on my app. You can download my app from the link in the description and check that course out as well. I'll be happy to answer any questions if you have on my WhatsApp. Thank you so much. I'll see you in the next chapter very soon. Bye-bye.